Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. The Department of Telecommunications directs online messaging platforms to enforce mandatory SIM binding for all users. A move is set to affect WhatsApp, Telegram, Signal, Snapchat and others. Telecom Minister Jyotiraditya Scindia tells CNBC TV18 the rule is the need of the hour and there will be no pause in mandates for SIM binding rules.
Wakefit files red herring prospectus with the Registrar of Companies. It is set to launch nearly 1,300 crore rupees initial public offering on the 8th of December. It's a mix of fresh issue of up to 377.2 crore and an offer of sale for up to 4.68 crore equity shares.
Atomberg Technologies is preparing for a $200 million IPO. The talks with investment banks has begun and is expected to appoint advisors soon, Bloomberg reported. The IPO is likely to include a mix of fresh issue of shares and an offer for sale. The listing may take place as early as next year.
Lenskart turns bullish on Singapore. This after the eyewear company said it has become the largest eyewear company in the Southeast Asian country. It's looking to double down on the region and strengthen its market leadership by offering 2-hour deliveries in Singapore.
Vietnamese electric vehicles maker VinFast, all set for the India Drive, set to launch a 7-seater multi-purpose vehicle called Limo Green by February next year. Also plans to roll out its full fleet from bikes to buses in a few years.
Those were the headlines that we're tracking for you this evening. On the hot seat today, Lightspeed Photonics, a deep tech startup building the next generation of ultra-high-speed optical interconnects for AI and high-performance computing, has raised $6.5 million in a pre-Series A round led by Pi Ventures. The funding comes at a moment when AI data centers worldwide are hitting a hard ceiling on speed, power consumption and scalability. Lightspeed claims it has a breakthrough, the world's first 200 to 400 Gbps solderable optical interconnect, promising 4 times faster data movement and half the energy use, all without redesigning existing system architectures. It's a story that sits right at the intersection of India's semiconductor mission, future-ready AI infrastructure, and a global race to solve the world's biggest data bottlenecks. Joining me now to discuss this further is Rohin Wai, the founder and CEO of Lightspeed Photonics. Rohin, thank you so much for taking time out and being here with us on Startup Street. You know, you are building the world's first 200 to 400 Gbps solderable optical interconnect, right? If you could explain to us what real-world bottlenecks in today's AI and HPC data centers are you solving for, and if you could sort of lay it out for us in layman's terms.
Well, the data center at the end of it is the primary real estate for people to get as much compute and as much bandwidth processing capability as possible. So today's biggest bottleneck is the systems and the compute that is sitting in the data centers is becoming increasingly divisive. So everybody wants to build their own systems and they don't want to play well with others. And that's where we become the bridge. So basically, an optical interconnect is kind of a glorified Ethernet cable, if you might. So it's about 100 times more data transfer capable. This, what I'm showing in my hand, is a 100 Gbps interconnect, for example, which is typically coupled with a fiber optic cable. And what we are building at Lightspeed, the solderable one, which you mentioned, is this tiny thing. This is 20 times smaller. So it's literally, it is coming down, bringing the real estate to as small footprint as possible and making data centers get as much per square foot area. And that is basically what we had a breakthrough with, and we have a lot more vision to go forward to.
Absolutely. And, you know, congratulations on the $6.5 million that you've raised, right? But what are your top deployment priorities? How much of this capital goes into commercialization versus expanding the R&D pipeline?
It's almost an equal split between the both, because as a deep tech R&D company, we have to stay ahead of the curve and stay internationally very relevant. Now, some of the bottlenecks typically a hardware company faces is, getting it right for the customers in the first go. We have done that. We did the launch. Now it is time for us to get into the pilots where we can deploy in smaller volumes, where customers develop real confidence in how the product is functioning on their premises. And this is one of those, phases which is a little different from a software company journey, where you have to do a strong pilot, and that's where the capital will be deployed majorly between R&D to getting into the customer's hands. And that's where major focus is going to be for 2026 and beyond.
Sure. And, speaking of your customers, if you could take us through your customer pipeline, are you already doing paid pilots with these OEMs or ODMs? When do you sort of expect to make any meaningful revenue?
Well, we did one paid pilot last year, and we have two more in the pipeline for the next year. And what the revenue target is going to have a major impact is when we hit the volumes, right? And that's where these pilots are very important for us, where we get the maximum pull out of these customers. So effectively, we work with the data center OEMs and also Industry 4.0 near edge on-premise solutions as well. So in those kind of scenarios, typically the questions immediately come down to what is your volume production capability? What is the price that we can work best negotiated on? Optimizing every piece of operations and every piece of production and leading it to the integration onto their board. So that is the dynamic that we will be figuring out in 2026, and 2027 is where we will start expecting, at least 50 to 60% of what we have raised in the first year itself as revenue.
All right. And you are promising 4x faster speeds and 2x lower power, right? So what new capabilities or form factors can we expect over the next 12 to 18 months as you sort of scale towards full commercial launch?
That's a really good question. Maybe just for the audience, I can just show what we are talking about, really, why I said it's a real estate problem. A typical compute chip looks something like this, right? Like you would see like an Intel chip or an NVIDIA chip. This is actually not a chip. This is a chips package, as you call it. And this sits on a motherboard or a network card where the traditional plug-based interconnects used to go in. And if you want to get, say, 1 terabit data out of this, so you have to literally put tens of this all around it, and you really don't have that kind of space in here. And what we are building, and to go to the next stage, is where the miniaturization is. So you talked about the 20 times reduction in the footprint is the major value add, rather than just the power consumption and increasing the data rate. Basically, what that means is if I reduce the form factor by 20 times, that means I can actually increase the bandwidth in the given footprint by 20 times. It's not just a 2x or a 4x increment, but actually it is a lot more multiple of that. That being said, power consumption is also becoming very prominent, especially the networking part of it. The one which I talked about, the connecting between multiple compute engines. None of the problems are a single compute, single server problems anymore. So they all have to work together with each other. And that's where the networking power is on the rise. It can go as high as 20-25% to 40%. So now that's where our targets are. We are trying to reduce the power consumption downwards to up to 10 times lower than what the current data centers are consuming in networking. And of course, the form factor reduction means that you can increase the bandwidth capabilities by up to 10-20 times higher. And the future R&D looks very exciting for us. There are multiple, patents, and the technologies that we have developed are truly international and interdisciplinary.
Absolutely. So exciting times ahead, and you've done a very good job of explaining that for all of us. All right, Rohan, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best on this journey going forward.
Thank you so much, and I look forward to great things for photonics in India, and we are one of the pioneers, and thank you for giving us a platform.
Absolutely.
Well, moving on and continuing with our hot seat segment, one of India's largest domestically owned contract food services providers, Rassense, has reported a 29% revenue jump to 471 crore rupees while serving more than 3.25 lakh meals a day across factories, campuses and corporate parks. From investing in AI-led operations and robotics to rolling out one of the most inclusive employee ownership models in the industry, Rassense is betting on scale, governance and technology to power its next phase of growth. To tell us what's driving the company's expansion, its roadmap to 564 crore rupees in revenues, joining me now is Sanjay Kumar, the Managing Director and CEO of Rassense. Sanjay, welcome to Startup Street. Now, like I mentioned earlier, Rassense has reported a 29% year-on-year jump to 471 crore rupees in FY25. What were the biggest growth drivers this year, and what is the current valuation of the company?
Thank you very much, Shruti, for having me on this show. To the two questions that you just asked, well, the growth driver was partly because of the initiatives that we put in place, but there was also a crying need in the market for an Indian company to work professionally and deliver contract food services across the country. It's ironical that 78 years after independence, India still is in a situation where no Indian companies even got listed in this space.
Yes.
So the market was expecting, that sooner or later somebody comes into this space. So we kind of were there at the right place at the right time. And I think that has helped us in driving growth.
Okay.
But additionally, if you see, the economy also has done well because we serve the sectors which essentially are consumption driven. So manufacturing is our core, focus area. And that's picked up really well in the last, 2 years.
Yes.
And we believe that it will continue to grow. So that's been the other driver. And of course, the fact that because we believe that the business is no longer about food, that technology will play a very important part in what happens in this sector. And we invested significantly in that space.
Yes.
Where the differentiation could then be visible to our customers.
Oh, and what's the current valuation?
Well, if you look at the market valuation in terms of what the current multiple on our stock market is, we would come in at 1x revenue. But it's anybody's guess, as you know, you can't predict the markets and you can't run ahead of them. Our basic focus has always been to build a strong, robust business. Within 2 years, we are profitable. We generate free cash of about 1.2%, so we don't burn cash for growth. And that will continue to be our focus, even though a significant part of our revenue goes in investing in technology.
Yes, yes. And picking up from what you just said, you currently serve 3.25 lakh meals a day across, factories, corporates and institutions. So, Sanjay, tell us what ensures client stickiness in such a large-scale, low-tolerance environment. And you've also maintained a 3.6% EBITDA margin. So how do you balance operational efficiency with quality at scale?
Partly. And also, we have let go of our ambition at times. There's always a desire to get more revenue, but we have had to measure, do trade-offs of revenue versus margin because we are not, a large multinational and our competitors are amongst the largest in the world. We are like a rounding off error on their balance sheets. So what's helped us is keeping this semblance of order. At the same time, to your question, what has helped us survive is moving away from the same story about responsiveness, availability, to actually making visible difference by using technology.
Okay.
And when I say that, it is right from the production process down to consumption. So how we buy raw materials, we have our own digital platform around that. How we build recipes by using the data of 7 years that we have on SAP, linking that to the consumption, which means how does waste correlate to the recipe? And trying and seeing whether there are tweaks there to bring down wastage, because that's the contribution then we make to the environment as well as to our margins. So it's much more complex than I thought it was when I started the business. But yeah, I'm beginning to learn.
All right. So, in fact, you've invested 2% of your revenues in tech. And thanks for sharing with us how you've automated or optimized your kitchens and supply chain today. But you are targeting revenues of 564 crore rupees next year. What are the new verticals, regions or partnerships that will drive this next phase of growth? Are you looking to diversify beyond institutional catering, towards food tech, supply chain optimization, or even meal analytics as platform?
That's a very good question, and it's very tempting to want to do more beyond what your core business is. But we have to keep reminding ourselves that let's not jump the gun. So let's first do what we are good at and do that well. Alongside that, continue to invest in technology. You'll be, happy to know that we've just copyrighted a digital technology that we deployed for material tracking, which is the first time in the world, this is not about India, that a material tracking tool has been developed, which we have already deployed across the country, where we produce these 330,000 meals. Sure. Now, you can argue that, in the rest of the world, material rejection is not significant. But in India, it's important because we focus on buying local produce so that we reduce the carbon footprint.
Okay.
And if you have to do that, you have to invest in technology to track what you're buying real time. So within 1 hour, across our sites where we produce 300,000 meals, we know the quality of our raw materials.
Sure. We're pressed for time. Very quickly, you've rolled out a share dilution program for employees, extending equity to site-level managers, something far more inclusive than traditional ESOPs. What impact has this had on productivity, retention, and culture? And also, I believe you have plans to raise some funds. If you could quickly answer these questions.
Okay, the rollout of ESOPs is something I personally don't believe. So we have actually given OCPRS, which is shares, because ESOPs, you never hit the target price. This is way much more, secure than that. This is the first time in India since it became a country that a food service company has given OCPRS or shares to employees. And in terms of future, we do get a lot of interest from both strategic investors and funds to want to invest in our business. But we believe we've already had one round of debt raised for the leveraged buyout, which was the first in the country, which was with Spark Capital.
Yes.
But for now, what we are thinking is that we will look at the next round more towards adjacencies to our core business, as also on in terms of inorganic, so that the business does not lose sight of the fact that free cash is important at the end of the day, no matter what you do.
Absolutely. And on that note, I'll have to wrap up our conversation. Many thanks, Sanjay, for joining us on Startup Street, and wish you the very best with all your growth plans.
Thank you. Thank you very much, and all the best to you as well. Take care.
On that note, it is time for us to head into a short break. But coming up next, home and furnishings company Wakefit is gearing up for its IPO on December 8th. My colleague Ritu Singh visited one of the company's factories to speak with its co-founder ahead of the big debut. That special report on the other side. Stay tuned.
Wakefit started out as a small D2C company that wanted to change the way Indians buy mattresses. Now, a decade later, it is a 1,200 crore rupee plus business that is preparing to enter the public markets, which is a very different arena with much higher expectations. At the center of that shift is this place here in Hosur in Tamil Nadu, where this factory behind me didn't just build the brand, it now has to prove that Wakefit can operate at the scale and efficiency and discipline that public investors will expect of it. But is the company ready to make that leap? We're going to go inside to find out. This factory, you can see how Wakefit has built its business around vertical integration, which means cutting, assembly, finishing, all of it under one roof. And this is the model that gives the company more control over cost and quality, especially as it looks to scale offline. Now, the real test is going to be whether this model can deliver Wakefit the kind of scale and margins that public markets will come to expect. Chaitanya, thank you very much for inviting us to your factory here and for speaking to us today. It's now been a decade since you started out to now, looking to enter the public markets. Just to begin with, for our viewers, as you reflect back on these 10 years, what are some of the 2 to 3 sort of turning points, inflection points that stand out for you that have shaped the way the company has grown?
I think when Ankit and I started about 10 years ago, we were both failed entrepreneurs. So every learning that has happened has been by following customers and what they wanted.
Yeah.
So if you really ask me about 2 or 3 inflection points, the first is we pioneered the 100-day trial policy for our mattresses so that customers could take it, try it in the privacy of their home,
Yeah.
decide whether they like it or not.
Yeah.
The second big thing was to look at a true omni-channel experience.
Yeah.
So we were a purely online company,
Yeah.
which was available on marketplaces and our D2C website. But about 3 years ago, we ventured offline in company-owned, company-operated stores.
Yeah.
That really gave a great experience to consumers, and our philosophy of educating them before they buy was a very big thing to be done offline.
Okay.
So these two were something that's very important for us.
A bit more about the IPO before we move on. Both you and Ankit are also selling shareholders in the OFS. You're offloading about 12.8 million shares together. What kind of message is that going to send to investors? What would you want to tell them about how invested you are in the growth story?
I think more than the specifics of that, what is more important is that post the listing,
Yeah.
we both still own a significant amount of company. I think it's closer to 35% if my memory is right. So we are here for the long haul.
Yeah.
We have built it for the last 10-11 years. My third venture, Ankit's second venture.
Yeah.
For us, Wakefit has been our life's work till now.
Yeah.
It's a very small portion given that it is a liquidity event after so long. But we want to continue doing this for a while.
So it is just that. It is just a liquidity event.
Yes.
There's no other message, so to speak.
Yeah, because when you have 35-40% still left,
Yeah.
you still maintain creative control, financial control, skin
Yeah.
in the game.
Yeah.
So we are here for building this.
Okay, let's also talk about the proceeds, because a large portion is going towards, 1, your offline expansion, and 2, your marketing expenses. I mean, rather than say, looking to build your digital channels or invest into the factories. So, what is the sort of thinking there? What are you trying to achieve?
Every company goes through its phases of different investments in different parts of its life cycle. So we have the Greenfield project that you see here.
Yeah.
It's one of the largest furniture factories in India. So during that period, a lot of the company's investments went there. Today, as it is scaling up, we need to invest in marketing. But as a company, we've always invested very frugally.
Yeah.
In the last few years, marketing has been between 8 and 12% of the
Okay.
overall revenue.
Okay.
So we've been very frugal, make sure that the company customer acquisition cost is low,
Yeah.
repeat is very high.
Yeah.
And so we've never been a company that's reliant on marketing for survival. It's necessary, you do it. So even that, if you look at the amount that we put in the IPO proceeds, it still amounts to the same 8 to 10% kind of a range. It is
Okay.
very, very sustainable as a company.
So, how do you project payback from the kind of investments you're making? Your losses have widened this year from the previous year to about 35 crores. What would you guide investors? I mean, while your losses have come down over the years, how soon before Wakefit is a fully profitable company?
So out of the 9 odd years that when we filed the DRHP, about 7 of them were profitable,
Yeah.
EBITDA and PAT positive.
Yeah.
The 2 years that we did go into losses was because of the huge investments we made
Yeah.
into the Greenfield project. That was never existing in India itself by any
Yeah.
company.
Yeah.
So today we've reduced that completely, and you will see that even in the coming years we will continue to focus on structural efficiency, ensuring that we are very, very frugal. So you'll see us even when the full year financials come out,
Yeah.
you will see that things have continued to improve.
Okay, let's talk about your omni-channel strategy, because you're spending a lot of energy into going offline as well. You have about 130 odd stores already. What is the plan over the next 3 years? What is an ideal mix for the company post-IPO?
The plan is to continue to open stores,
Okay.
but it is always going to be calibrated. We don't take a store opening target,
Okay.
because that is the wrong incentive to give to the retail team. You will, in your hurry, you will choose the wrong micro markets, you will choose the wrong building, because you are trying to achieve a target. So what we want to do is open a steady 3 to 5 stores every month.
Okay.
Make sure that they pay off very well. The payback period is very low, and you choose the right place, right building.
Yeah.
So that is the target. So it's not to open a X number of stores. In terms of the mix, we are not going to be measuring ourselves on that. We are going to be measuring ourselves on the own channel revenue.
Okay.
Because own channel would mean our D2C website and our stores put together.
Yeah.
Because consumers research anywhere, browse anywhere, purchase anywhere.
Yeah.
So we cannot just say that I will not be present here or I will drive transactions to a particular channel.
Yeah.
But what we do measure is as an integrated number of
Yeah.
store plus D2C website, that should be large.
Yeah.
As of the DRHP time, that number was 55%.
Yeah.
Which means where our reliance on marketplaces is less.
Yeah.
Post that, if you look at the full year financials, that's gotten better. I'll be able to talk about the specifics once the RHP is filed.
Of course.
But that's improved even further.
But how long does it take typically, and now that you're talking about opening these jumbo stores, to break even per store? How does the unit economics also work?
The payback period is, I will be able to say that the payback period is about less than a year.
Okay.
For the individual stores, but the jumbo stores are large format stores that are very prevalent in our industry of furniture.
Yeah.
But it is something that we are trying out now because we believe that's a great way to demonstrate that Wakefit is a design destination.
Okay.
With a complete home product, if you have the 4 walls, you should be able to get everything from Wakefit. That's Ankit and my plan and dream.
Well, we're here in Hosur. It's one of your largest facilities. You have 5 at the moment. Any plans to, open more facilities? Are you target expansion with this fresh money that you'll get from the IPO?
Expansion has to be based on what capacity we need.
Yeah.
So it's not a pet project to build factories. So today what we have is really good for the next 2.5 to 3 years.
Yeah.
So as we come to that inflection point, we will think of the next either greenfield